So again, today's topic is director's salary, best practice. So what's on the agenda for today? I'm just going to do some housekeeping and then introductions of who I am. And then we're going to dig into today's topic, which is director's salaries. We are then going to have some time for some Q&A. And as usual, if you stick around until the end, there is a gift in store for you. All right. Some housekeeping. This webinar will be recorded and the slide desk will be provided upon your request. We're going to talk about the director's salary, the best practice. And as usual, because I am a tax consultant after all, we will talk about the tax implications and then Q&A. A little bit about myself. So I consider myself to be a risk taker. I mean, like, who leaves the comfort of corporate and goes and starts their own company? Yes, there isn't an element of being a risk taker. I currently run and own Zumo Consulting, where we help small businesses pay little to no taxes, legally, of course. But over and above that, we also do bookkeeping as well as payroll on a monthly basis. I'm a mom of 4. Why did I start this company? Well, I realized that a lot of small businesses owners are great at what they do, but the financial side of their business is not necessarily their strongest point, which is where we come in to say we are here to assist you. What do I hope for you from this webinar? I hope you're going to come out with a better understanding in terms of how directors' salaries are determined. You know, it's more of an art than it is a science, but we'll dig deep into that. A disclaimer, né? I am not a financial advisor. This is not meant to be financial advice. However, I am here to just clarify why business owner hardly ever get the answer to the question, how much should I pay myself, right? Because when it comes to financial advice, there is a lot of elements that are involved, like your age, your risk, your level of risk, what it is that you're trying to achieve. So it's always best to reach out to a certified financial advisor. So I'm wanting to share with you examples of what I've seen happening in the industry when it comes to directors determining their salary, and also based on my experience. Okay. Okay, poll time. You know, guys, this is supposed to be interactive, so please do interact with me. Raise hands when you've got questions. Tell me, either in the chats with an A, B, or C, did you join this webinar because you don't know how much to pay yourself? Or is it B, I need somebody to tell me how much to pay myself in my own company? Or is it C, I miss having a boss who told me what my salary should be? Or is it none of the above? I just want to get a feel of where people's heads are at, right? So if you can just type in the chat what your answers are. Okay, C, I miss having a boss who told me what my salary should be. Ah, that's a good one. Thank you. And thank you for your honesty. I really appreciate it. And that is why a lot of us are here. And we also have a B. I need someone to tell me how much to pay myself in my own company. Imagine. There's a lot of C's, guys. This is so surprising. D, none of the above. Okay, great. All right, cool. All right, so this is what I want to share with you. Guys, you left corporate because you wanted to run your own company, right? You you must remember that your company is basically like this is your house. This is where you set the rules and the tone that you want to follow. So that's why you'll see that nobody ever actually tells you how much you should pay yourself because this is your company. You can decide to take all the money that you want that's coming into the business, or you can decide to put in a percentage or whatever feels comfortable for you. So you make the ultimate call. All we can do is just advise you. And then based on that, you will decide what it is that you want to do. You know, determining how much you pay yourself is like when somebody asks, how should I raise a child? It's up to you how you raise a child. We'll talk about what the norm is, the norm being what other people do. And then you then decide, is that what I also want to do? Okay. Ultimately, this is what I'm trying to say is you determine how much your salary should be. So when you are deciding, there's a number of things that you must take into account which will be impacted. One, you personally, what your salary will impact you personally, your family. That does have an impact. There will also be an impact to your business because if you take all the profit that the company is making, what will be left for the business? How are you going to grow your business? And then there's also the taxman. How much you pay yourself, there's tax consequences for that as well. Okay. So the assumption for this webinar, right, is that a lot of the people that are here are small businesses, business owners. And you'd find that those people that are the owners of the business, meaning that they are the shareholders, are also the directors of the business. And they also work within the business like any other employee. So that's what I mean when I say that you are probably wearing three hats within your organization. One, you own the business. Two, you are the director within the business, meaning that you are steering this ship into whatever the vision is. And three, you also work in it, meaning that you still get involved into the actual work. So I'll give you an example in my company, because I also do wear these three hats. One, I'm an employee because I still have to go in and check that the work is still done correctly, right? Like any other employee in an organization. I still need to check that the bookkeepers, the senior bookkeepers, things have been done correctly. So meaning that I'm still employed within the organization. Two, I'm also the director, meaning that I'm involved in the decision making within the company. Three, I own this company. Therefore, I'm also the shareholder. I'm the one who's got the vision of where I want this company to go. And I'm the one who is directing it towards that vision that I want it to go to. And I also work within it. So technically, I should be paying myself 3 times, right? Which I think a lot of us here would agree. Okay. So what I'm about to share with you, right, are recommendations of what other people are doing. So when people say this is common practice, they're just saying this is what happens in practice. But like I indicated, you still have the final say in terms of what it is that you want your salary to be within your organization, particularly if you are the shareholder as well as the director within the organization. Okay, let's get So the first thing that you will look at when determining your salary is what the industry benchmarks are. So meaning that if I'm an accountant, I'll go look at what other owners and directors of other small accounting firms are paying themselves. So that's what we mean when we say you look at the industry and benchmark accordingly. So if when I've done the research, I see that directors of accounting firms earn between 15,000 and 10,000, which they don't, by the way. It's just an example. Then that gives me a guide of what the industry that I'm operating in is saying should typically be my salary. So you would look at what the industry is currently saying as a guide. The other thing that you must consider is profitability of your company as well as cash flow. Now, there's a reason why we say profitability and cash flow, because these are two separate things. You could find that your company is profitable, but there is no cash in the bank. So let me give you an example. You issue an invoice to a customer of R1,000,000, right? And then your expenses come to, let's say, 700,000. So keeping it very simple, which means your profit is now sitting at 300,000. So according to the income statement, your company is currently profitable. However, when you go look at the bank, there's no money in the bank because the company that you have invoiced is probably only going to pay in 30 days. So as much as the industry could be saying that this is how much you should be paying yourself, you still have to look at the profitability of the business as well as the cash flow. Because when there's no cash in the business, it's hard for you to then say, this is how much I'm going to pay myself, right? So you need to assess both the revenue, the profitability, as well as the cash in the business. The other thing that you have to consider is the long-term financial plan and growth objectives of the company. If you take as the director of the company all the money that is coming into the business, how is your business going to grow? Right? So you must also determine what is the long-term financial plan for your business. And based on that, you'll see of the profits that you make, how much can you be able to take out and how much you should leave back into the business for the growth of the business. Then the other thing that you have to consider is your personal financial needs. Guys, let's face it. You left corporate to work on this business. So this is where your money is currently coming in. So how much does it cost you to be able to survive? What are your living expenses? It's pointless for you not to pay yourself enough to cover your bond, your children's school fees. So that also needs to be taken into account when you're determining what your salary is. You need to take into account your living expenses, your debt obligations, your personal savings goal when determining your salary. So let's get into an example because a lot of us need to see what it is that we're talking about. So the first thing we're going to talk about is if you decide in your company that based on the factors I spoke about, which is the industry, the profitability, as well as the cash flow for the company, the growth of the business, as well as your personal needs. You then decide, I am going to determine my salary as a percentage of profits for myself. So let's get into an example. Okay, please let me know if you can see. You should be seeing an Excel spreadsheet. Thumbs up. Yes, you can see my screen. Somebody, anybody. Can you guys see my screen? Okay, thank you, thank you. Sorry, I didn't see the thumbs up. Okay, great. Okay, so let's say we're using example one where you're saying you're determining your salary based on a percentage of the profit for the organization. So let's say that your average sales for the business was 2 million. And then your cost of sales for the average cost of sales per month is 1.3 million. Therefore, your gross profit is about 700,000 and your gross profit percentage is 35%. You then say, based on that, the minimum I'm going to pay myself is either 15% or 20% as a maximum. So you say my salary is a percentage of gross profit, and based on the industry, based on what I feel the director, I am worth, I'm going to pay myself 15%. Or you can be conservative and say, I'm going to pay 10% as a minimum. And as a maximum, I'm going to pay 15%, right? What this will then determine is your minimum salary would then be 70,000. And then your maximum would be 105. So then you can put in criterias to say, when do I pay myself the minimum of 10%? Or when do I pay myself the maximum? Okay. Minimum could be based on if in that particular month you are trying to invest as much money into the business or you need to buy assets within the business, then you can pay yourself the minimum amount. The maximum amount, if, for example, it's December or the company did very, very well, and there will be no cash flow implications if you pay yourself the maximum amount, then that's what you'd go with. Again, this is more of an art than a science. You need to look at those 4 factors that I had previously indicated. And then based on that, you can determine what percentage you want to go with. Okay. Any questions on that example? Feel free to raise your hand if you've got any question on that example. Okay, cool. Okay. Now, there are some pros and cons when you pay yourself a percentage of profits, right? The pros are the director's salary is linked to the performance of the company, meaning that when the company did well, the director gets a high salary. When the company did not do well, the director gets a low salary. Again, what that can do for the director is motivate them to ensure that the company performs well, because they are very much clear that their salary is performance-based. It's linked to how the company performed. Okay. Then the other thing you can consider is that when the director's salary is linked to the performance of the company, then there is an incentive to grow the organization, right? Because you know that if the company performs well, I'm going to get paid more. Then one, it's beneficial for the director, but it's also beneficial for the company. Okay. The cons is that your salary is not stable. It fluctuates based on the performance of the company. Now, that can negatively affect your personal needs, whereby if the company has not performed well, your expenses in your personal capacity will not be covered correctly. And then there's also the risk of resentment from employees, because we've all heard of this, where directors get paid high bonuses when the company performed well, whereas the employees, which are a critical element in the running of the business, are only paid a fixed salary. So you can then decide in your company that maybe when the company performs well, the employees also get a percentage of the good performance within the organization. The other option you can look at is paying yourself a fixed salary. So meaning that when you did the assessment of how the industry pays directors within your industry, how much they pay, you then say, okay, they pay themselves 100,000. So I'm going to pay myself 100,000 no matter what happens. That's the salary I'm going to pay myself. So that would be your fixed salary. So the pros to paying yourself a fixed salary is that it's predictable, meaning that every month you know exactly how much you're going to pay yourself. There are no surprises. Your expenses will be covered regardless of how the company performed. And there is a level of consistency because it's fixed, right? And the employees also perceive you as being credible, if I can put it that way, because you pay yourself in line with how they get paid as well, which is in terms of a fixed salary. The cons, however, is that if you pay yourself a fixed salary, then how the company performed is irrelevant. Whether the company performed well or not, you don't get affected. So there's no element of incentive to ensure that the company performs well, because no matter what happens, you get paid yourself, you get paid a fixed salary. Now, there's also the risk that there is a lack of alignment between the performance of the company and what it is that you are trying to achieve within your organization in terms of growth and the fixed salary that you paid. Because in times when the company has not performed well, and perhaps the company needs you to invest more into the company in terms of marketing, in terms of sales, you are paying yourself a fixed salary and you don't consider what the impact would be in the company when it's not performing well. And then, guys, have you had the concept of pay yourself first? One, who has heard of that concept and who has done that? The concept of paying yourself first. Let me just check mine. Okay, so the concept of paying yourself first is basically you investing, saving money first before you pay anybody else within your organization. So meaning that if a client pays 100,000 and you follow the concept of pay yourself first, which is, let's say, 10% of any money that comes in, 10,000 gets put aside into savings. And then whatever is left to pay for your costs, is left to pay your employees, is left to pay your overheads, right? Is left to pay even your salary. So the concept of paying yourself first is centered around putting money aside for the growth of the business first. So you prioritize saving within your organization before any expenses are paid, right? I'm not sure if anybody here does follow this concept of paying themselves first. It's something I personally have tried to do. It's a little bit tricky when you are still growing the business, whereby you want to invest as much money back into the business. But as the company grows, meaning that sales increase, it does give you more room to be able to save and pay yourself first in that sense. Okay, another poll. Thumbs up or thumbs down? Did you leave your job after your side hustle could pay you your salary? Because when I was in employment, I was told that don't leave until your side hustle is giving you enough money, the same salary that you're getting from your current employment, right? I see some thumbs up, some thumbs down. Okay, I was more of the thumbs down, guys. I left before I had one retainer client, and for me, that was enough to say that this model works. I am leaving. And besides, I think I had just had enough of employment. So there's pros and cons for either. If you left after your side hustle was paying you enough, it means that even when you transition, chances are there's enough revenue to pay yourself a salary. But if you were like me, where you left before your side hustle could afford your salary, the first couple of months and first couple of years were a little bit tricky because I was still trying to get the company to the level where it could generate enough sales to pay me a salary. Okay, so let's talk about people who say that they can't pay themselves a salary. They can't, right? This normally happens at the beginning stages of most companies, whereby there's not enough revenue to sustain a director's salary. So that's why they can't pay themselves a salary. What this means is, guys, you need to go hustle. You need to bring in more sales within your organization so that you are able to pay yourself a salary. And then I'm looking at the time. Then there's people who choose not to pay themselves a salary because, one, they don't know how much to pay themselves, which I hope this has sort of clarified that. Two, they don't want to pay themselves a salary because they don't want to pay taxes. Guys, we live in a country where there are taxes. So trying to avoid the tax man is just going to lead you into more trouble in the future. So rather pay yourself a proper salary rather than deducting money or your personal expenses going through your business account. Because one day you will need investments, and nobody's going to invest in a company whereby personal directors' expenses are going through it. I know I wouldn't. If I see your children's school fees or Netflix going through your business account, which means you're using your business account as your personal bank, right? So it makes it hard for you to get people to invest in your organization. All right. I'm quickly going to talk about the tax implications. When you pay yourself a salary, there is obviously pay as you earn that you need to consider. There is also, if you say, okay, I'm not going to pay myself a salary, I'm rather going to pay myself a dividend, right? Then there's dividend tax that you also need to consider. You say, no, I'm not going to pay myself a dividend. I'm rather going to take out money in my company as a loan. Then there's interest on that loan that you need to consider, right? So either way, however you pay yourself, there will always be tax implications. But tax planning comes in whereby we would sit down with you and assess which method is going to result in less taxes for you to pay. As we've established, there will be taxes, but let's try and see if there is any other way whereby we can reduce the taxes available. Okay, I'm going to stop there because I'm looking at the time, guys. I'm sorry. I just want to ask are there any questions, any burning questions that you might have? Feel free to raise your hand and just unmute if you've got any questions for me.
Pamela?
Yes.
It's Tabile. Morning, and morning to everyone.
Morning, Tabi.
Yes, of this session.
Mm.
My question is mainly around what you've just shared with us now. Does it apply across the board in terms of the different legal formations in the types of businesses that we would ordinarily get into? For example, would what we discussed today or we got taught on today apply in an NPC, NPO trust, those kinds of legal formations, or it's just more convenient in the PTY LTDs, your CCs type of legal entities?
Okay, great question. And the simple answer is, in general, the answer, it should be applicable across any entity because it always depends on what the goal is. Are you trying to invest as much into the organization? It also depends on the strategy that the company is trying to achieve, right? Perhaps the strategy for a nonprofit company versus a profit company can be different. So that's what causes differences. So what matters is really what the strategy is for the company that will guide you in terms of the salary compensation. Okay. I hope I've answered your question, Tabile.
Thank you. Thanks.
Okay. Yes, go ahead. Fatso, you can go ahead.
Hi, Pamela. Thank you.
Mm.
Here I see you are referring to a single director. So if I'm the only one running the show as in a small business setup. But when we've got executives, when we're looking at the percentage method, is there maybe, say, a particular percentage that we should be capping for all leadership to say, okay, for the executive team, where there's 3 or 4 people, at 15%, that's it. And then the rest of the staff members will then get the remaining whatever percent, or maybe a better way to put my question, is there a percentage we can say this goes towards payroll as a whole? So payroll, this, and then we'll see out of that much, how much do I pay myself? Is there something of that nature?
There is no real such percentage of that nature, because there are so many components that you need to take into account in determining your decision, right? Things like your target that you're trying to achieve for the growth of the business, things like what the industry is paying the executive versus the directors, how much you want to invest back into the business. So that's why you would find that nobody would actually give you an answer to say that you should pay yourself X amount. And remember, this is your company. You still have the ultimate say to say that this is how much I'm going to pay myself, because it is your company if you are the shareholder as well as the director. So you still have the final say. There are some industry norms where they can say between 6% and 8% of the gross profit, right? But again, it does matter in which industry you're operating in. That's when you'd use those industry norm as a guide. Again, it is just a guide. You can decide to pay yourself the salary based on the profit, the sales, or the net profit after taxes even. So there's a lot that gets factored in you determining how much it is. And you'd have to look at those 4 factors I indicated: the industry that you operate in, your personal expenses, the growth and strategy for the business, as well as the, what was the 4th one now? Oh, I forgot the 4th, but those 4 ones. So there's no exact pay yourself 10%, pay yourself 5%, because then somebody would be telling you what to do in your company, and it is your company. Okay. Cool. Any other questions? Okay. All right. Yes, Tabil, I'll take your final question and then I'll officially close the webinar. But I will stick around until 10 o'clock.
Okay, thank you, Pam. The next question for me is, we are currently talking about a scenario where you are wearing different hats: shareholder, director, and employee.
Yeah.
If they, in a situation where there is employees and you are a director and a shareholder again, would this scenario also apply in such a situation? I guess what I'm trying to find out is there a set of guidelines for director fees if you're a director only and not an executive or an employee, versus if you are an executive and an employee but not a director? Is there a different set of guidelines for the benchmarking or the strategy on remuneration?
Okay, so for employees, it's like when you decide to take on a secretary, right? You would look at what the market is currently offering secretaries, because you're not going to attract anybody if you're coming in too low. Okay, or the people that you do attract are not going to be at the level that you'd like them to be because you're coming in too low, right? Or if you're trying to attract, let's say you're trying to headhunt somebody, then you're probably going to come in higher than what they're currently being paid in order to get them to be an employee within your organization. Again, that's why it's like there is no set figure to say this is how much you should be paying employees. You look at a number of factors to determine how much the salary should be. And then you do negotiate, because you'd find that an employee really wants to work for your company. They like the culture, they like this and this and that, but they are not willing to work within the company because the salary is too low. Are you with me? So unfortunately, guys, there is no set figure. And that's why even when you're employing people, even if you're employing directors, there is an element of negotiation. There is an element of basing it on the strategy for the organization. So that's why people don't say it should be 5%, it should be 10%, it should be 15%. You need to do the necessary research for you to come up with the figure that's going to be comfortable for you and the employee or the director within the organization. Now, if you've got shareholders who are not directors, then the shareholders would have an idea of how much the director who is not a shareholder should be earning, based again on the industry, based on their experience, based on the objective for the company. So there's a lot of factors that come into play when determining the salary. That's why there's nobody who's saying it should be this amount. Okay. Cool. All right, I'm officially going to close the webinar because it is meant to end at 9:30, but I am going to stick around until 10 o'clock just to answer any additional questions that you might have. Thank you so much, guys, for attending this webinar. The next webinar is happening on the 14th of March. Are there any topics that you preferably would like us to address at the upcoming webinars? Because these webinars are truly about you business owners. I can come up with ideas of what I want us to chat about, but you can also give your input so that I know I'm addressing any needs that you might have. On upcoming webinars, I'm also going to start bringing in industry experts on different areas within small businesses of how maybe you can get more funding, how you can get more clients, any other information that is currently not known a lot by business owners. So that is something that I'm working on. Okay. Thank you so much, guys, for your time. I really do appreciate it. See you at the next webinar, which is the 14th of March. Thanks. You can stick around if you've got questions, but otherwise, I'm done with the presentation. Okay. I'm just gonna answer some questions that were raised. A question that was asked is, if you're a director of a company, should you contribute towards the UIF? The answer is yes, because directors are also employees within the organization. So you definitely still do need to contribute towards a UIF. Remember, UIF is for your benefit. In case you as the director are unemployed or you go on maternity leave, whatever the case may be. So you having that insurance would definitely benefit you, even if you are a director. There's another question. The other question is, what are the specific director salary brackets by law? I hope this has clarified it. There is no set rule to say directors should be paid this much and that much, right? However, once you've determined how much you're going to pay yourself as salary, there is pay-as-you-earn consequences that you need to consider. And those are based on your salary bracket. As we know, the more you earn, the more taxes that you pay. So the tax element is very clear. If you earn this amount and you fall within this bracket, this is the amount of tax you are going to be paying. So that is in black and white. Okay. Okay, cool. I think I've answered all those questions. Okay, are there any other questions? A. Gray, Alfred, Bongani, Howard, Lyndon, Imelda, Tabile? Do you need any clarity on anything? Okay. Okay, cool. If there are no, oh yes, Bongani.
Hey, Pamela. Awesome webinar. Like super brilliant. Really, really good.
Thank
I don't
you.
know where you've been hiding, all my life. Quick question. Can you just share it once again? Because I just got the link through via the via. Can you please just share your firm's details? Maybe how we can get in touch with you.
Sure.
Maybe if you can post it in the chat so we just copy and paste.
Not a problem.
Because I feel like Cyril is sitting on my shoulder here and about to fight. So I just need to sort out a few things, and I would appreciate your input. Thank you.
Not a problem. Okay, I'm just gonna share my screen now. Okay, so these are our contact details. We are available on 073-490-1703. You can send us a WhatsApp, whatever you're comfortable with. If you still need to check us out a little, our website is www.nzumoconsulting.co.za. You can send us an email at sales@nzumoconsulting.co.za. We operate within the borders of South Africa. So whether Eastern Cape, KZN, wherever, we can definitely be able to assist you. Okay. And we're available on all social media on Nzumo Consulting as our social media handle. Okay, Howard has a question. What's the general acceptable repayment term for a director's loan? And how does SARS view these? Okay, so SARS views loans as if the company is financing you, right? So meaning that there should be interest that is charged. So you can't just get a loan from the company and there's no interest complications. There is interest implications because the company is basically providing you finance. So the loan that you get, there should be interest that is charged on it. Okay. Now, the payment terms, that's between you and the company. You can then say, I'll pay this loan within a year, within 2 years. Again, you need to consider the implications for the company if you don't pay it quicker, because now the company is going to have less money for it to be able to grow. And remember, at some point, you are planning on selling this company or transferring it to somebody within your family. So your succession planning comes into play. If you plan to sell this company and there is this loan, that loan will have to be settled as part of the settlement of the company, right? So at some point, the loan has to be settled one way or the other. So it just makes sense to consider the strategy of the company and what the implications will be when you don't settle the loan in a reasonable time. Okay. Okay, cool. I think I have answered. So the question is, can salary be set off against the loan or part of it? Say not taking the salary on certain months. Okay. So salary and loan are two separate things. So either you pay yourself a salary, like you said, in times when the company is doing well, I'll pay myself a salary. In times when the company is not doing well, I'll pay myself a loan. So don't combine the two, because there's tax implications that you need to consider, which are treated differently, whether it's a salary or a loan. So rather don't combine them. Rather pay yourself a salary or don't pay yourself a salary and just take out a loan. Okay, yes, Bongani?
Sorry. Director's draw versus drawing a loan versus salary. What because I think when we start to engage with accountants, they kind of throw these things around, Yabo. And whereas we are practitioners of our specific field. So sometimes people throw jargon and they think or they assume that you know what you're talking about and implications that it has on you, right? So one would say, hey, should I take a salary because I need to generate a pay slip for myself? No, just take a director's draw. Okay, but wait, we haven't done your personal tax in over 2 years. Well, I thought I was just chowing the money from the business. Like what are the implications and how do those things sort of operate interchangeably? I don't know if that's clear.
Yeah, no, it is clear because we get this question a lot. And a lot of people think that there is a set answer to say either pay yourself a salary, draw money from the company, take out a loan. Again, it depends because there's so many implications. So let's say you say, I'm not going to pay myself a salary. I'm just going to take out the loan from the organization. Okay. One, there is obviously cash flow implications under all of these for the company. And then there's tax implications because salaries has pay as you earn. If you take out a dividend is probably one of the things that also gets thrown out. If you take out a dividend, there's also dividend tax that you need to consider. If you take out a loan, there's interest expenses that you need to consider. If you take out drawings, when you take out drawings, you're basically taking out the equity out of your company, right? So how does equity come about? Year on year, your company, let's say it is profitable. So year one, it made a profit of 10 Rand. Year two, it made a profit of another 10 Rand. So the equity within your company is now worth 20 Rand because that's the equity that's left within the organization. That's the growth that your company has had. Now, when you take out drawings, you're basically taking out of that 20 Rand, the growth within your organization. What are the implications for that? When you are now trying to sell this company, a buyer is going to look at the equity of your company. And now you have taken out a percentage of it. So it's going to be worth way less than if you had just paid yourself a salary. But salaries also does have tax implications. So there's so many elements. And that's where tax planning comes in because we need to sit down with you to say, okay, what are you trying to achieve exactly? And then based on that, what are the implications? Because we've seen directors who pay themselves the minimum salary so that they pay the minimum tax. Fine, that makes sense. But now that director in their personal capacity wants to go get a house worth 2 million. But now because they were paying themselves the minimum salary, they only can afford a house of this amount because that's how much their salary has been. And then so there's so many elements that we need to consider when determining what it is that would be beneficial for you, because we need to know what it is that you're trying to achieve at the end of the day. So that's where tax planning comes in as well. And this is normally done at the beginning of the year to say, what are your objectives for this year? And then what can we do to ensure that based on what it is you're trying to achieve, you will end up paying the least amount of taxes. We've established that you will pay taxes, but how can we make it possible for you to pay the least amount of taxes? So there's a lot that needs to be considered when determining whether you pay yourself a salary, you draw money out, you take out an interest, or you pay yourself a dividend. Okay, I wish there was a cut straight answer, but there isn't, because there's so many things that are involved. Okay.
Just one last question, Pamela, on what I've asked before.
Yeah.
Because my questions are more in retrospect. Okay, I understand now if there's best practice going forward, especially if you want to sell the company in the future and all. But in retrospect, that's already been done. It's not an either or. There is a set salary with a certain tax liability for every month, pay liability. That's still going to be paid, but on certain months, instead of getting that net salary, then it's actually treated as a repayment. It's set off, but the tax due for that month will still be paid as per set salary.
Let me see if I understand correctly, Howard. So if for, let's say, okay, there's 12 months in a year. So for the first 5 months, you're paying yourself 5,000, 5,000, 5,000, 5,000. And let's say pay as you earn is 1,000, 1,000, 1,000. So you're saying if in the 6th month, you decide not to pay yourself a salary, will you still have to pay as you earn?
No. Well, what I'm saying is at the beginning of the year, set the salary. This is my cost to company for the next 12 months.
Yeah.
Everything's calculated on that. There's a pay slip every month. There's a tax liability to SARS that's got to be paid every month. That doesn't change for it. That carries on. But on other months, there could have been draws as a loan. So what I'm saying, let's say on month 7, 8, 9, you say you're still paying that tax, but you're saying whatever was due as a net salary goes toward repayment of the loan.
Yeah, I don't see that being a problem because ultimately, if I'm understanding you correctly, you're saying that you still pay yourself a salary and instead of taking your net salary to go pay, for example, your bond or the kids' school fees, whatever it is in your personal capacity, you decide to go pay back the loan for the
yes,
company.
And it will be reflected as such.
Yeah, no, there's nothing wrong with that.
Payment.
Yes.
Whether in that month or at the end of the financial year, reflected as that.
Yes.
Okay, that was what my question was coming about because I am guilty of that. So it was a personal question.
Okay, yeah. No, remember that loan that the company has been giving you money, it needs to be settled one way or the other. So the best way is when you get money in your personal capacity, which could be from a salary, then you pay back the loan. There's nothing wrong with that.
Okay, and in terms of the interest that's charged on the loan, is there a guideline to what's that going to be set at?
Yes. So SARS says the interest should be based on the repo rate plus 1%. So whatever the banks are saying is the repo rate, you should calculate that plus 1%. I think currently it's 12.5% of the loan should be interest should be charged at 12.5%.
Repo or prime?
No, repo.
12.5 is it? What is that?
Hold on. I actually have it here somewhere. I'm gonna share my screen now because I was actually looking at this yesterday as well. I don't know. Okay. Okay, you should be seeing a table that says interest rates. This is as per June 2023. Oh, sorry, not 12. My bad. It's 9.5. So currently, this is what you should be charging. And it's the repo rate.
Yeah. +1, or is it
+1.
is that a +1 already?
No, the official rate is linked to the repurchase rate +1.
Okay.
You see what I've highlighted there?
So now so it changes with if your repo rate changes in 3 months' time, so you adjust it accordingly.
You'll adjust accordingly, that's correct.
So you can't fix it then.
No.
Okay, no, that's fine. That'll stop me doing it in the future.
Okay. All
Okay,
right.
no, thank you very much.
You're welcome, Howard. All right. I've got time for one more question before load shedding hits and my network. Okay, cool. If there's no other questions, thank you so much, guys. This recording will be shared with you, so do not worry. We'll send you a link to watch the recording if there's anything you want to touch base on. And if you have any questions, you can please reach out to me or my team member. And then, yeah, we'll address any questions you might have. Thank you so much for your time. See you at the next webinar. Take care. Bye.
Yes, bye.
Bye.